Think inflation is cooling? Then why aren't your input costs still going up? After this, you'll understand why your break-evens aren't falling and what that means for your 2026 and 2027 decisions. General inflation has cooled compared to the spikes we saw just a few years ago, specifically right after COVID. But for farmers, that does not necessarily mean costs are coming down. I'm Michael Langemeier, Director of the Center for Commercial Agriculture at Purdue University, and this is Commercial AgBrief, quick research-based insights to support better farm decisions. Before we get started, don't forget to like and subscribe for more updates. Farm input prices don't just follow inflation, they often rise faster and move more unpredictably. Over the long run, general inflation has averaged about 3.4% per year. That's inflation on consumer items. Farm input prices have increased about 4.1% annually. That gap may seem small, but over time it has a major impact on cost structure, margins, and break-even prices. But what really matters is that not all inputs behave the same. Some costs, like labor and machinery, tend to track closely with general inflation. Those items are also used in other industries. That makes them more predictable, but others like fertilizer, fuel, and feed, and I would also add feeder animals, are driven by global markets, energy prices, supply shocks, and other things. And that's where volatility comes in. Here's the surprising part. Even when inflation stabilizes, your costs might not. Over the past year, inflation increased about 2.8%, but total farm input costs rose more than 10%. That disconnect is exactly why break-even prices for crops like corn and soybeans haven't come down. And when you break it down further, the variation is even more important. Fertilizer prices, especially nitrogen, phosphorus, and potash, have risen much faster than inflation in the last year. More recently, we've seen additional pressure. Diesel prices jumped 34% in March, and anhydrous ammonia increased about 13% in March. Compared to a year ago, if we go April 25 to April 26, anhydrous ammonia prices are now more than 40% higher. So what does this mean for your operation? Three key implications. First, don't rely on inflation headlines alone. Lower inflation does not necessarily mean lower costs, and that emphasizes the importance of looking at cost budgets. Second, watch individual input categories, especially fertilizer and fuel. And third, expect continued volatility in break-even prices, which can directly impact margins and acreage decisions. The bottom line is this: inflation still matters, but it's only part of the story. Understanding which costs track inflation and which are driven by their own market forces is critical in today's environment. You can read more in our latest article from the Purdue Center for Commercial Agriculture, linked in the description below. Subscribe for more research-based insights, and we'll see you next time.